Hi, everyone. I'm Lorenzo di Mattia, the manager of Hedge Invest Macro Fund. I wanted to discuss what happened in October and then give you the outlook for the rest of the year and next year. October was a profitable month for us, although marginally, and then we got more profits actually at the beginning of November. We're already up about 1.5%. We were bearish coming into October, and once our model confirmed the possibility of a big correction, we got short, and we shorted U.S. index futures, the DAX, and we've also bought put on the S&P. Although these positions were not big, and in hindsight we should have been bigger, and we closed a touch prematurely, everything went pretty well. So we profit from those positions. After almost 3 weeks of downside, we covered, which turned out to be a touch premature, but still very good. And then, since we didn't expect a bear market right away, but rather we expected a transition between bull and bear, characterized by sharp corrections and then rally back, not near the highs, but at least recovering 2/3 of the correction, we started to buy, and it turned out to be a touch premature, but we were very small. We were very disciplined in building the position very slowly, and so we ended up actually making money on the long positions as well, and we closed those positions at the beginning of November. For the rest of the year, we still there are more confirmation that we are in a phase of transition between the bull market and the bear market. One of the things that didn't confirm in the past, which was U.S. credit, in particular high yield and high grade, is starting to deteriorate as well. So we really think, estimates are too high for the S&P for next year. There's still around 8-9% growth in earnings for 2019. Besides the USD, US dollar that's rallying, and sort of peak earnings because of margins, interest expense, and labor costs are increasing. Besides that, the recent oil collapse will lower capex. And we experienced that in 2015, 2016, where there was actually an earning recession, although it was small, about 5-6% down. The bottom line is that the S&P will not have 8-9% earning growth in 2019. If we are lucky, we get 3 or 4%, but it could be zero growth. With these valuations, it's easy to understand that the market will go down. So we expect one last tactical rally into the G20 because the trade war will not be as bad as people expect. Probably we won't get the worst of the tariffs in January for China, and there is a dialogue ongoing. But beyond that point, we really believe there is significant downside. So 15, even 20% from the peak in the S&P. So we're talking about 2,400 to 2,200, and we're ready to short after that. At the moment, we're tactical long, and lastly, we're looking for a long position in U.S. Treasuries, the 10-year. Although we believe we're a few weeks, maybe a month or two early, but that's something we're looking at. Thank you very much.